Imagine waking up to a world where forgotten currencies are suddenly on every banker's desk. Not rumors, not chat room noise, but real operational planning. Banks, exchanges, and compliance teams moving fast because they have to. Today's discussion explains why even the possibility of a sharp move in the Iraqi dinar or Vietnamese dong forces institutions to prepare. Planning does not mean certainty. It means risk control in case something big happens. When people talk about values far above current trading levels, it creates pressure instantly. Governments, banks, and private exchange operators cannot wait until after an announcement. Infrastructure must exist before demand explodes. A move of that size would trigger massive demand to convert paper notes into usable funds. That demand alone is enough to force planning. Counting, verification, settlement, and security all take time to build. This is where redemption centers come in. They are not rumors or secret rooms. They are controlled locations where physical currency becomes digital money or bank credit under strict rules. These centers can be bank branches, temporary facilities, or licensed exchange houses. Their job is volume, accuracy, and legality. Without them, even a valid rate change would turn chaotic. Normal bank branches cannot handle sudden crowds with bags of cash. So planners map out extra locations, extended hours, mobile units, and appointment systems. Order matters when money moves fast. Every redemption center requires trained staff, secure equipment, and verified processes. Notes must be authenticated, recorded, and reported properly. This is where theory turns into reality. Before any center opens, approvals are required. Governments decide who can operate, what identification is needed, and how transactions are reported. These steps slow things down but protect the system. Next comes logistics. Cash transport, vault storage, and settlement pipelines must be ready. Large volumes cannot move without armored transport and coordinated timing. Staffing is another pressure point. Counting high volumes quickly while detecting counterfeits is a specialized skill. Training takes time and mistakes are costly. Technology ties everything together. Scheduling systems, transaction logs, secure databases, and real-time reporting are mandatory. Without tech, the process collapses under its own weight. Legal and tax handling cannot be added later. Authorities must decide how gains are treated, what reporting is required, and which thresholds trigger reviews. Unclear rules create delays and disputes. Public communication is just as important. People must know where to go, what to bring, and what not to believe. Silence creates panic, clarity creates flow. Planning does not mean a rate change is guaranteed. It means institutions understand that building a safe system after the fact is almost impossible. Preparation always comes first. Liquidity is another silent driver. If many holders exchange at once, foreign currency must be available. Banks plan credit lines and correspondent access long before any event. Pricing methods are also debated. Fixed rates bring clarity but risk losses. Market pricing reflects demand but can swing wildly. Each option has consequences. Settlement timing matters. Some funds move instantly. Others require staged transfers or delayed access. These choices affect trust and stability. Security planning goes far beyond guards. It includes transport, insurance, cyber protection, and emergency response. Cash events attract risk from every angle. Crowd control is not optional. Appointment systems, phased rollouts, and coordination with local authorities prevent dangerous situations. Poor planning puts people at risk. Fraud prevention is constant. Counterfeit notes surge whenever exchange talk rises. Centers rely on forensic tools, serial tracking, and shared intelligence. Education protects holders. Clear warnings about scams, fake centers, and private middlemen reduce losses. Fraud thrives where confusion lives. Central banks sit at the core of everything. They define rules, timelines, and authorized participants. Private planners follow policy, not online speculation. International banking relationships decide speed. Without correspondent trust, funds move slowly or not at all. Compliance strength determines access. Geography also matters. Holders are not evenly spread. Planners consider regional hubs, mobile units, and overseas access where possible. Diaspora holders add complexity. Cross-border rules, local banking laws, and reporting requirements must align or delays grow fast. Verification rules balance access and protection. Small holders face fewer hurdles. Large amounts trigger deeper checks. This tiered approach protects both sides. Damaged or old notes cannot be ignored. Clear rules prevent disputes and speed processing. Ambiguity slows everything. Communication plans fight misinformation. Official lists, hotlines, and verified updates block scams before they spread. Timelines vary. Some transitions are phased and calm. Others are sudden and intense. Planners prepare for both. For holders, the advice stays simple. Ignore private offers. Verify official sources. Store notes safely and document ownership where possible. This level of planning does not predict outcomes. It reflects responsibility. Institutions prepare because failing to prepare costs far more. Redemption center planning is about control, safety, and legality. Not hype, not promises. That is why serious planning begins long before headlines explode.